money on their insurance. They make money on their investments. Okay? So premiums are paid in advance, and the insurance companies invest that money. But they have to be mindful of the fact that some of that money has to be available to pay claims and, of course, to pay the ongoing operational expenses. All right, so investment income is very important to reducing the cost of insurance to policy owners. In other words, if insurance companies have a bad year with their investments, they're going to have to raise premiums. So it's a point of competition. If you've got real good portfolio managers and you earn a higher return on your investments, then you're making a higher profit and you will be able to charge lower premiums for the same risk. And you're going to increase your market share. Okay? And the insurance companies, as we saw, they rely on the investments to help cover losses in the underwriting process. Okay? And let's not forget how important insurance is to an economy. And every time we have a war, one of the things that we do is we send experts into the country that's been defeated to help them develop an insurance industry, which in turn helps them to develop their economy. It's important to have an insurance industry. Okay? So you got to be careful with the investments. All financial services companies are vital to the health of a country's economy, and so they are highly regulated with regard to the investments they can make. They have to be safe, they can't be too crazy, and we saw what happened when they got crazy back in from 2003 to 2008. Insurance companies got crazy with their investments and with the policies, their products, and we almost lost some major companies and they had to be bailed out. All right, so insurance companies are regulated with regard to what securities they can own and what percentage of their assets they can put into each type of investment. So insurance companies have to manage their investment portfolio in a way that's real similar to how they have to manage their underwriting portfolio. They have to spend a lot of time and effort looking at their investments.
So wouldn't investing in companies and securities that insurance companies invest in be a safe bet for individuals?
Yes. Yeah, because they're gonna use securities that have low volatility and a lot of liquidity. So they would use those objectives. Any individual who has a similar objective, which is low volatility and a low probability of default, we're all going to use the same types of investments. Okay? There's a certain pool of investments that are that are available to everyone. Okay? So insurance companies, unless they structure private deals, which a lot of them do because of their bulk, I mean, they have so much in money to invest that they get a volume discount when they buy some securities that individuals aren't going to get. Okay? And they can go to a developer, for example, who's going to develop a $300 or $400 million apartment complex. And they can fund it through 2 or 3 insurance companies that want to make those loans in the form of bonds directly to the developer. And it cuts out a lot of the middleman, and it's a lot quicker, and the insurance company gets a higher rate of return than they otherwise would. All right, so here's a graph of the financial services industry and where all the assets are. And this is 2009, so it's several years old. But you can see that pension funds, these are retirement plans. hold the highest amount of assets. And then mutual funds, and then insurance companies. And you can see these are the big three. Okay, so this is where most of the investable assets are located. Okay? Banking's not in there. And banking is going to be right up there with the rest of them, with the other three. Okay? So this is all lines of insurance. These are the assets, investment assets of all lines of insurance. So about 12% of total global financial assets are held by the insurance industry. It's pretty big. It's a huge industry. All right, and so what did we say that number was? 23 trillion. And of the 23 trillion, 5 trillion is life insurance assets. Okay? And I think this reflects the aging of the population, and it also reflects the buildup of wealth in the population. More insurance policies that are out there, and the premiums have built up. So the assets held by the life insurance companies have really, really grown. All right. So a life insurance company divides its assets into two types of accounts on the balance sheet. Two types of accounts. Okay. The general fund, the general account, funds the death benefits. Okay. And that's going to be the largest pool, the general account. And this is where, so all of the insurance companies employ an army of actuaries. And the actuaries and the regulators tell the insurance companies how much they have to set aside in order to meet their liabilities. And their liabilities are this: benefits for life insurance. Okay? So they know, based on each policy that they have, each year, they predict what their payout's going to be. And they have to keep those payouts liquid. They want that money earning some return, but it has to remain liquid because they know that money's going to be flowing out. Okay? So, for death benefits, you got bonds and mortgages and real estate investments. Pretty stable stuff. Pretty stable. So I worked for a regional investment firm, and we had about 60 stockbrokers, and we had about 125 institutional bond brokers. And the institutional bond brokers sold bonds to insurance companies and banks who needed to invest their money. So when you call an insurance company, you don't say, hey, we got $5,000 bond here to sell, would you like it? You say, we have 500,000 worth of this bond. And I know those guys were making $40,000 and $50,000 and $60,000 a month back in the early 80s. That's the kind of income, because once they got in with a client, once they found the right person at a bank or an insurance company, and that person trusted them, the money spigot opened up. It was amazing. And that's why if you saw Wolf of Wall Street, you saw the kind of crazy stuff that happened. Oh yeah, it happened. It happened. We lost several guys in car wrecks. They were driving Porsches and things like that they rolled. because they all had gold Rolex watches, and they were burning the candle at both ends. And a couple of the firms in Little Rock got busted because they were selling more cocaine than they were bonds. It was a crazy, crazy time, yeah.
So where does the process actually start for a bond to be owned by an insurance company? So like your real estate guy, he's not gonna roll up to the insurance company and ask
Right.
for financing, right?
Well, you can, if you're the real estate company, you can employ someone whose job it is. And as part of my job at an investment firm, I did that, okay? I helped bring together investors with developers, okay? Or you can employ an investment firm. Just know that anytime you employ somebody else, they're going to take a cut out of it, okay? So you can have somebody on staff. It just depends on what your needs are. If you do, one project every 2 years, you don't need somebody full-time to do that, But, that may be one function that your chief financial officer does, Or you can use an investment firm who says, oh yeah, we'll be able to line up the investors for you.
So it's generally a bigger project, or it's a company that has those connections. Otherwise, you'd just be dealing with the bank for like residential.
Well, the bank is one option, okay? The question is, what is going to be, for a developer, what's going to be your best option to get the financing? And the best option means the shortest period of time it takes to get the money, and the most liberal terms about paying back the money, and your rate. All those things come into play. And sometimes it's going to be the bank. If you have a bank that's really aggressive, you go straight to the bank, and they say, we'll match what anybody's going to do, and we can do it. We can get this thing through underwriting in a week. But other times you have to go to an investment firm. It depends on what banks are available to you, and what their attitude is at that moment in time about real estate projects. Because sometimes banks are real aggressive, and they want that business, and sometimes they're like, I don't care how good the project is, we can't put on any more real estate loans. Okay. It's a really interesting area, real estate finance. All right, so you got the general account for the life policies, and then you have the separate account. Okay, and that is the investment portfolio that backs up investment products like annuities and pension plans. Okay. So with these things, what you have is a stream of income that goes out. And more often with a life policy, you got a big, you might have $1 million or $2 million that goes out at one time. Okay, and we're going to look at life policies. You have different options with a life policy, how you want to take your benefits. But some people just say, write me the check. Okay, and so these guys, you have to have the money available to fund these big amounts of benefits. Whereas these are monthly incomes that are $2,000, $3,000, and $4,000 a month. Now, you've got a lot of participants, so they add up, but there are a lot of assets behind them. Okay? So, in the separate account, and this, we'll get into the different types of life insurance products that are out there. You have to invest the money the way the client wants you to invest the money. So you see a lot more stock exposure in these accounts than you do in these accounts. So the client has no say whatsoever when it comes to funding the death benefits. And they have no say with regard to how the insurance company is going to invest. The regulators do. But down here, the client, this is like 401k products where the client, you show the client, we got 12 different funds that you can invest in, and they put money into those investments. All right, so there's a higher degree of stock exposure in the separate account. So which account you're in depends on what it's funding, what kind of product. All right. So you can see that the general account death benefits are much larger than the separate accounts. Okay. So by 2015, you got roughly $5 trillion in here, and you have roughly $2.5 trillion in the separate accounts for $7.5 trillion. And again, to give you some idea, the U.S. at that point, the national debt was about 15 trillion. It was about 15 trillion. Of which a lot of it resided right here in these portfolios. And Grace isn't here in China, as Donald Trump would say, China. This morning I had to pick up my lawnmower. I had to replace the pull cord and another piece. And I took it back and I got home and I pulled it to start it and the cord popped. Pow! So I put it back in the back of my SUV and took it back to the repairman. And he said, "That was quick." And I held up the rope and he goes, "Those darn Chinese." That's what he said. I thought you sound like Trump. All right. He's an older guy. Okay, so this is a breakdown of what the accounts look like. So in the general account, you can see 72% of the general account is invested in bonds. And again, you've got people working at the insurance company. So you see what this is, what this represents is jobs for finance people working at insurance companies, managing these portfolios, okay? And you can look at there. All right? And again, this is regulated. This is regulated. So you got 82% invested in bonds. That doesn't leave a lot of room for other investments. And then here, look at that. Okay, so where you end up working in the insurance company depends on what you're interested in, what you're good at, what your experience is. Are you more interested in stocks? You're going to be working with the separate accounts. If you're more interested in bonds, you'll be working with the general account. And you can see mortgages and real estate, much smaller part. All right, and again, a lot of this, as we'll see when we start covering universal life and variable annuities, a lot of this is just directed by the client. The client says, "This is where I want to be." All right, this is property casualty. So you can see that, again, it's dominated by bonds because there are a lot of smaller claims that happen on a very regular basis. So they just can't afford to load the boat with stocks. Okay, they want to earn a nice return, but they've got to stay liquid, and the regulators know that, and so the regulators are involved with that too. But let me tell you something. You can take a lot of risk with bonds. You can take almost as much risk as you can with stocks. Okay? There are a lot of different ways to invest in bonds. All right, we're on the last page. Just to give you an idea, you know, of the kind of jobs that are available at insurance companies. Okay? So, IT, and none of these is going to be a surprise to you. Okay? Accounting, legal, insurance companies employ a lot of attorneys. So you go to law school and you might not want to practice criminal law or divorce law. You might not want to practice corporate law, securities law, okay? You might want to practice contract law. And if you want to practice contract law, then you go to work for an insurance company. And I know several people who do, okay? So this is actuarial work and portfolio work. HR, very labor intensive. A lot of people work for insurance companies, okay? Sales and marketing, okay? Everything from the creative side, putting together commercials, to being an agent, okay? And I tell you, I know insurance gets a bad rap, but I said this on the first day of class. It's a nice life, okay? I've got several friends, looking back on it, I wish I had strongly considered it. I don't think I'd be good at life insurance, but I would have been better at property casualty, because life insurance, you really have to get out there and hustle and sell people. Property casualty is just, people know that they have to have it. You want a driver's license and drive a car, you got to have insurance. You want to buy a house, you got to have homeowners insurance, okay? So life insurance, really, it's the same thing. You got to have it, but there aren't any laws requiring it, okay? So when you tell somebody you're going to have to spend $1,000 a month on a life insurance policy, man, they're going to go apart. Okay? It's like, man, I don't want to spend that kind of money. I'd rather spend that money on vacations and cars. Whoops. I thought there were more. Okay. All right. I'm going to let y'all out 6 minutes early. We're done with chapter 6. Moving on. Peace out. Shalom. That's right. I took my mask off. You going to report me? I'm talking to you, Sloan.